Death and taxes. You've probably heard it said these are the only two certainties in life, and well, there's a reason for it. As much as some of us might want to live forever and owe nothing to Uncle Sam, you have to pay your taxes, and eventually everyone's time runs out. But one concern I hear time and again is what happens to our plans and finances if I die early and my spouse lives for another couple decades? Well, that's what we're going to discuss in this video. And while there are a ton of concerns that people will have when thinking about their spouse outliving them, I want to focus in these three areas in particular: income, taxes, and health costs. We'll discuss how each of these can be impacted, and we'll take a look at some examples within someone's plan of how an early death impacts them, their surviving spouse, and ultimately their finances. But first, I'm Curtis Crossland of Suttle, Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. The first area to discuss, and this is one that can get hit the hardest when a spouse passes early in retirement, is income. And this can hit multiple different ways. What if the spouse that passed had a pension? What if the couple was planning their lives on the basis of 2 Social Securities? What if they had a life-only annuity, or even worked part-time, or had other consulting income? Survivorship can be greatly affected by the decisions made on some of these income sources. I come across situations all the time where one spouse has a large pension but no survivorship. I've also seen spousal situations where they started Social Security early and didn't think about the survivorship angle of when to take Social Security. And not everybody knows this, but when you die, your surviving spouse gets the higher of your Social Security benefit, or theirs, not both. So taking Social Security or a pension early is also going to affect income in survivorship situations. The downside risk to all of this in a failure to plan is that a surviving spouse possibly has to go back to work. Closely tied to the concerns of income is also the concerns of spending. The most recent Bureau of Labor Statistic report shows that average retirement spending was $54,975 per year, and that's a monthly average of right around $4,581. Spending may not necessarily just cut in half if a spouse dies, especially if the survivor is still carrying a mortgage or trying to pay off a car or other debt. Income loss can create significant budget challenges, though, and put more stress on investments. The second big area of focus is taxes. What happens to your taxes when a spouse passes away? Well, for a newly single person, a change in their tax brackets can be pretty impactful. It can make distribution strategies and conversion strategies more expensive. And even if you're one of the lucky ones whose income doesn't dramatically fall off, you may find you face an entirely different problem, and that's an increase in your effective tax rate and more taxes owed on the same or similar income. And the way that you think about effective tax rate is you divide the amount of federal taxes that you paid by your taxable income. This can cause issues if you're trying to budget and find you have a few less dollars in your pocket. The downstream impacts are also magnified with being in higher tax brackets: required minimum distributions, investment income, rents and royalties, how much of your Social Security might be taxable. These are all affected. And for those that are trying to leave money to family, higher taxes on your investments now can mean less makes its way to them, or you're less able to do tax avoidance strategies, as we've seen in examples in some of my other videos. The third major area of effect that we'll discuss is healthcare costs. On the surface, this may not seem as big an issue, but in circumstances, it absolutely can be. If a deceased spouse had retiree health benefits, those may be lost. A surviving spouse may also face higher premiums, having to move to individual coverage if there's a loss of any group benefits. Moving from married filing jointly to single will also affect the cliffs at which Medicare's IRMA kicks in. And this can be especially painful if income wasn't lost or affected, but an increase in Medicare premiums acts as an added surtax. Tied also to this could be the potential for increases in long-term care costs. Oftentimes, one spouse will care for another that may be going through end-of-life situations and providing them care that may now need to be paid for. These are all issues that you have to consider when you're thinking about your retirement plans. Let's look at a few examples of each of these at work, and while we do that, think about your own situation and let me know in the comments if what you're dealing with is different or if this hits home. Let me know as well what other angles of survivorship you'd want to see. Also, let me know if you think I missed something or just want more details. So let's take a look at a couple examples of some of these concepts at work. And the first place that we're going to start is taking a look at how a change in income due to an early death can affect the plan. Now keep in mind, none of these examples are meant to be exhaustive. I've got other videos that go into more detail. I'll provide links in the description on those if you want to check them out. They're more related to tax planning. But here we find ourselves looking at a couple familiar faces, Joe and Jane. As we can see, they're not quite 70 yet, but they are retired. And if we take a look at some of the other particulars about their situation, we can see that total net worth about 1.5 million, and what that's made up of is some value in a home that is paid off. We do have a couple 401k accounts totaling $1 million between the two of them, and then $75,000 in the bank. On the income side, we see that they're already collecting Social Security. They started that when they retired at age 62. You can see that here. And in this particular example, we're going to say that Joe has a small pension of $30,000. We're going to say that that pension is for life only, meaning it's only going to be while he's alive that he's getting paid this money. We're not going to have any cost of living increase. And really the key factor here is showing that there is no survivorship on this particular pension. Some of the other specifics, if we come over here and take a look at the spending for them, I provided that average expense number according to the Bureau of Labor Statistics, but that's statistics from a couple years ago. Things have not exactly gotten cheaper. So in this example, we're going to say that they want to spend or can afford to spend right now $7,000 per month. We see that they also have a vacation budget of $20,000, and we're going to say that's going to go for a period of 10 years. So now the big question is, how does their retirement look on the surface? And as we can see here, they have a pretty good looking outcome, 95% according to the Monte Carlo. If we take a look at the projection of assets over time, we see that the median actually does grow. That terminal median value showing $2.5 million roughly by age 90 or end of life. And we don't see anything within that projection crashing out to zero in that 5 to 95% level. And so now what we're curious about is, how does this change, or how is this affected if Joe is to pass away early? And we use Joe in this example simply because he holds the pension. But if we say that Joe is going to pass away at 70 and then Jane's going to end up living to 90, let's see what type of impact this has. And so at least in this example, we can see a reduction or a dip in that Monte Carlo, or that probability of success. It went from 95% over here down to 84% if Joe is to pass away early. But the other interesting thing to note is that the projection of assets, that median terminal value, dips from that 2.5 number down to 1.8. And if we take a little bit of a deeper look, we can see that if Joe does pass away early, we project to have $730,000 less ending assets than if Joe is to live to 90 right alongside Jane. Now, where might somebody run into trouble with this particular issue is if there are going to be elevated costs later due to end of life. But one thing that people that may find themselves in this situation will ask is, well, what do I do? What if my spouse passes away early? What if they had a pension, and now what if all I have is their Social Security or mine? I have this reduced income. Suddenly, I have to live off of less income. What happens? Well, we have not yet affected spending. The odds of Jane spending the same $7,000 with her on her own as she would have spent with Joe is pretty low. She would have to find reasons to spend above and beyond what it would take for her to live as a single person. Now, for some, this may not be difficult, but the reality is that this number is likely to dip. And even though Jane is debt-free, what is realistic for her? Well, it's going to be different for her compared to anybody else. So what would a single person spend on their own? Well, that's going to be a different answer depending on who you ask. But in Jane's situation, let's say that she's going to have a reduced spending amount, but she still wants to live a fairly rich life, maybe dote on the grandkids, or give more money to charity, or basically just simply have more financial involvement. Well, a reduction in that spending amount from $7,000 down to $5,000 a month with no other adjustment does show us with an improved Monte Carlo, does show us with higher median terminal balance amounts, as we can see here. So again, while this is a little bit idealized, for those that find themselves in a position where maybe this 95% changes to like 40 or 50, the answer is almost always going to come from a reduction in planned spending. And it's really going to have to, unless the alternative is you want to go back to work. So hopefully you don't find yourself in that situation, but if you do, we can kind of see how that reduction in income and the loss of your partner is going to affect your finances, but we can kind of see what the lever to pull here is. It literally is either find a way to spend less, and if you can't, that's a circumstance where you're going to have to find a way to pick up additional income. So this also creates the importance on thinking through, well, what do you do if you are in line to receive a pension? How do you make a decision on that? And this can be difficult. It's very alluring to look at, well, what's my maximum monthly payout? Let me go for that. I'm healthy. I'm going to live, the full 90 years, or I'll live at least into my 80s and think you'll be fine. But you have to consider that the reduced amount that you'll receive on a pension to provide a survivorship benefit is in effect you purchasing insurance on the continuation of some amount of that pension. So it's a very important point to take if you're in line to get a pension. If you're not yet considered that, think about the long-term implication of that decision. So in this case, it worked out okay for Jane, but there can be situations that I've come across where it's not very pretty. So while a reduction in income is nothing that anybody wants to deal or face, it's not necessarily the end of the line. There can definitely be situations where a surviving spouse is going to have a change in lifestyle, but may not necessarily have to go back to work. So the next part of this I want to take a look at is, well, what happens when it comes to the taxes? This can also be a big change as it relates to going from married jointly to single. And so I'll put it up on the screen here, but you can see the difference in these tax bracket levels going from married filing jointly over to single. We actually see a reduction or a squeezing, if you will, of the amount of dollars it takes for a single individual to hit that next marginal bracket versus a married couple who has a much bigger cushion before they hit that next bracket. Capital gains tax is another one. Depending on how you're able to file, the amount that you're able to show before you hit that next increase in taxes is going to be different. You have less margin or you have less cushion as a single person versus a married couple when it comes to things like the long-term capital gains as well. So a retired couple may have a very set income situation. They may have a very good understanding of what's going to happen when it comes to their investments and other production. And then going from that married situation to a single situation can create issues if there's not much of a change in that income or production. You could find that the squeezing or narrowing of these brackets and then the reduction on a lot of the means tests that you see can increase the tax impacts or tax effects that a single person will face. But what I want to look at here is really just a side-by-side example. We'll take a look at how a change in the tax brackets might affect just a very straightforward situation for them going from married jointly to then Jane being single. But I'll tie to that one of those strategies I talked about before, which is this notion of trying to convert. Since they do have a good amount of 401k asset, as we saw earlier, they may have a real opportunity, as we'll see, to do conversions. And pay attention as we go through this to see how a change in these tax brackets can affect some of these other strategies that people may want to be running in retirement. So here on the left, we can see the scenario where we have the married filing jointly. We've got both of them listed here. Now, for the example, I'm saying that they are 70 just to keep this easy. So Joe and Jane here are 70. And then on the right side, we're going to say, okay, Joe has passed away. Jane is going to continue. Jane is 70 over here as well. But moving down and taking a look at their income here, no wages, no other wage income. We're going to say they have some taxable interest. This will come from the bank account. So having cash in the bank, having some interest produced there. Everything else is in the 401k for their example here. But on the left, notice this. If Joe is still alive, we're saying that he has that $30,000 pension. On the right here, if Joe's out of the picture, all of a sudden Jane no longer has that. So there's that reduction in income. But at least in the initial example here, as we go through the numbers, we can see that it's big total income difference. We see adjusted gross income down here. Continuing on, we see that in a situation where they're retired, where the income is very low, technically the highest bracket they would be affected by is 10% marginal, but there's no taxes owed because their income is so low. So if you're in a situation where a spouse passes away, and you don't really have any assets that you're looking at in terms of conversion or some sort of strategic use, if you don't have a situation where you have maybe a great big investment account that's kicking off a lot of additional dividends or income or capital gains, this may not be an issue. This might be a non-issue, in fact, where you don't have a real change in your tax. But to those that are going to be affected by this, it can become a real headache. So let's jump back up and let's take a look at what might cause a headache so we can see the difference. So again, we're going to look at married filing jointly on the left, single on the right. And the easiest way to try to take a look at the impact of this is simply for us to add in something right here for the Roth conversion. So let's say that Joe and Jane decide that they want to try to do conversions from those 401ks over to the Roth IRA. Let's say they want to be fairly aggressive in that, trying to stay within that 22% bracket for themselves and eventually get those assets over to the Roth. That way they can leave that as a legacy. Well, in the example here, if they are both around, Joe's got his pension at $30,000, they're going to convert 100. If Jane is single, just to kind of keep the numbers the same in terms of the income to show the difference or the impact, we're going to say that if Jane was single, if Joe did pass away, she would convert 130,000. What that would do is that would give us the same total incomes. And then after total income, we see that adjusted gross income is the same number between the married situation and the single situation. But now this is where we start to see a difference. Over here in the deductions, we see that the married deduction is quite a bit higher than what we have over here on the single. These are just the standard deductions for each. And we see how that then affects the taxable income. So much higher taxable income over here for Jane as single versus over here if Joe's around and they're still married. And then look what this does in terms of the total tax projection. So in the married situation, total federal tax estimate here, just under $6,000. Single, remember, same total income. Single, though, we have federal tax estimate of $14,687. And also take a look at what happens in terms of the marginal brackets. Because Jane is single, she's basically getting squeezed in terms of those marginal brackets, which means the same amount of income she's showing as single as she would have as she's married is pushing her into higher tax brackets. The other big deal here is this effective tax rate. Look at the difference. If you're married, you get a much lower effective tax rate than if you're single for the same amount of total income. So total tax estimate's wildly different. So what might this affect? Well, if you're Jane, are you going to, convert the $130,000 and, try to keep the income the same? Well, no. But what if you were trying to keep the tax relatively the same? So if we're trying to shoot for, let's say, a $6,000, tax impact to Jane as single, what would have to be different in terms of her income? Well, let's take a look. And so I'm just going to change this to a number that I know will get us very, very close. So now Jane is saying, okay, I can't show the same amount of income as an individual as I did when I was married. I'll do less in terms of the conversion. That will show us up with less total income. I'll have less adjusted gross income. When we come down here and we take a look at those projections once more, well, okay, now we can see that our total tax is much closer. We're in that marginal 22% bracket, but our effective tax rate's still a little bit higher. And that's because, again, of those narrower brackets on things like the 10% and the 12% level. And so you might look and say, well, 90,000 versus 100,000 in the conversion, not that big a deal, but you can see how this is going to have to affect decision making. What if they had much larger 401k balances? What if they had a goal that was to try to get more money to heirs on an after-tax basis? All of that can be affected. The narrowing of those tax brackets makes this much more difficult. It's not impossible to still do some of the advantageous strategies that may exist out there, but it's certainly much more difficult now to try to engineer an income situation that is similar and still have some of those benefits. And let's take a look at how healthcare costs can be affected by this as well. Up in front of you here, what you're going to see is basically a chart showing the Medicare premiums, parts B and D, and we're going to take a look at how that IRMA surcharge can start to come into play. So you'll notice that in the married filing joint category here, there's much higher numbers when you hit that first cutoff to see your part B and D premiums increase, versus if you're just a single individual. So you might say, well, that's just not fair. But fair or not, that's going to be reality. So again, if you're in a situation where you and your spouse have built this financial engine that produces a lot of income for you, if let's say that continues or persists, even in spite of one of you passing away early, now you can see how some of these things are going to impact these other costs in these other areas. And so something to highlight with this, though, is that if you do trip Medicare's IRMA, and the way that Medicare's IRMA works is it basically is a 2-year look back on your modified adjusted gross income, and it takes that number and it compares it, or it does that means test against these particular brackets. If you end up having the Medicare IRMA surcharge, it is only for that year. They do a means test each year to determine if you're going to have an elevated cost. But this isn't exactly a cheap impact. That first level that you hit, that amounts to essentially about $88 per month. So it's $1,000 tax in the year if you're just at that first level, if you end up cresting over that initial cutoff. And remember that Medicare's IRMA is a cliff. So it's not like the marginal tax system where that next $1 of tax is taxed at that higher marginal rate. No. If you as a single individual have $106,001 of modified adjusted gross income, you're going to trip that increased Medicare IRMA cost compared to somebody that has $133,000 of modified adjusted gross income exactly. You'll have the same cost. And notice how expensive these tiers get as you go up. So if you've done a fantastic job of building this wonderful income engine for yourself, and if that is going to persist in spite of your spouse passing away early, just get ready for some of the additional cost. So if this is something that is going to be an issue to you or something that bothers you, well, what can you do? Well, you've got to find ways to keep your adjusted gross income low, but oftentimes that is a balancing act, or it's going to come in spite of something else, meaning you may have to give up something in order to keep the modified adjusted gross income low if you are specifically trying to keep those health costs low. And this is really just one aspect of it. But I'd love to know, as we've worked through these examples where we've seen things affect the income, seen things affect the taxes, seen how things can affect in a very similar way the healthcare costs. What are the challenges that you're running into? What are the things that, come to mind for you when you think about the impacts of having the loss of a spouse in retirement? I'd like to know that. And keep in mind, as we've explored these things, these are just three of the big areas that I chose to highlight. There could be other areas that come to your mind where you think about, hey, if my spouse passed away early, it'll affect me in this way. It may not necessarily be financial, although oftentimes it certainly is, but let me know, what are those other areas that can be affected? What else needs to be planned for? The goal again is really just to get you to start thinking about where else might I be affected. That way, if there is something that you need to do or to shore up, you have that opportunity. Did any of these numbers or changes surprise you? Do they make you feel more or less comfortable with your own situation? Survivorship is really something that nobody enjoys talking about, but when it comes to your financial plan, you have to consider all of these angles. Ask yourself this: how many old couples have you seen pass away together at the exact same time? And how many situations have you seen with friends or family where instead one spouse outlives the other by several years? This is a big need for every couple situation to consider when putting together their finances and plans. It also makes concerns on longevity risk and the need for proper long-term portfolio management important as well. So if you don't know what to do, or if you just don't want to do it by yourself, consider working with a professional and be sure to check out our links. And also, if you got anything out of this video, I would love a subscribe and let me know your thoughts on this topic down in the comments. Who knows, maybe I'll do a video about your concerns next. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.